A great business is currently on sale. PepsiCo, the parent company of Pepsi and countless iconic snack and beverage brands, has seen its stock price fall 33% from its all-time high. In fact, the stock is down over 20% just in the past year. And as the stock consolidates at these new lows, it may be one of the best buying opportunities for Pepsi in decades. This is a dominant business with reliable and growing earnings. It is a dividend king with over 50 consecutive years of dividend increases. And after this sell-off, the dividend yield is now 4.33%. This is by far the highest dividend yield over the past 5 years, and it's crazy to imagine just a couple years ago, the dividend yield was only 2.5%. This current 4.3% dividend yield is actually the highest ever for PepsiCo stock, at least in modern history. The yield didn't even get this high in the great financial crisis. Today I'm going to do an updated stock analysis on PepsiCo, ticker symbol PEP, and explain why right now may be the best buying opportunity for the stock in decades. That will include a full look at key financial metrics, an analysis of PepsiCo's dividend growth and safety, a look at some of the key reasons for the sell-off, and a DCF valuation on the company, along with analyst price targets. But first, I need to let you know about a great deal to get 50% off dividenddata.com and lock in that price for life. This summer sale is the best price we ever offer, and it will only be available for a limited time. So if you want to follow along and use all the tools I show throughout the video, like this AI analyst, a stock analysis tool with great data visualizations, and the ability to track your own dividend portfolio along with a lot of other tools, now is the best time to join. So click the link in the description and pinned comment of the video so you can get access to this summer sale. If the tool helps you find just one better stock, then it way more than pays for itself. With that said, let's roll the intro and jump into Pepsi. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. To paraphrase the great Warren Buffett, you should only invest in businesses you actually understand. So before I get into the stock financials, let's talk about the business of PepsiCo. This is one of the largest snack and beverage companies in the world, and its origins date all the way back to 1898. Over time, the company expanded and expanded, going global and acquiring all of these iconic brands that you may not even know are owned by PepsiCo. As we look in beverages, that includes names like Pepsi, Gatorade, Tropicana, Mountain Dew, 7-Up, and Aquafina, and that is just scratching the surface. And in foods, they own Frito-Lay, Quaker, Doritos, Cheetos, Lay's, Tostitos, etc. This is a global business with about 60% of their annual revenue coming from North America. As you can see, the North American beverage business is about 30% at $27.7 billion. The North American food business is 29.9% of revenue. And although the stock price for PepsiCo has been going down, this company has so many competitive advantages and it is not going anywhere. This company has been producing high cash flow for decades and decades and decades, and that's why it's been a dividend growth stock all those years. They are very disciplined at not only being profitable and generating cash flow, but returning those profits to shareholders. The company's wide portfolio of brands help create an economic moat. These are products that are in the mind of consumers, and that creates a lot of inherent advantages, whether it's shielding shelf space from competitors or leveraging their existing brands to create new products. The company has also built up crazy infrastructure. They have a global supply chain and distribution networks to get these products all over the world. There's a lot of work that goes into producing these products, shipping them all over the country, and then actually getting them on shelves. And it's that large distribution network that lets the company acquire new brands and scale them fast, and form strategic partnerships like they did recently with Celsius energy drinks. However, like I said at the top, the stock price is down because the company is facing some short-term challenges. But before I get into the key reasons for the sell-off, let's jump into the big picture stock analysis. The current share price for PepsiCo is $131. Over the trailing 12 months, they've generated $6.80 in earnings per share. That's based on GAAP accounting, which gives it a 19.3 PE ratio. The forward-looking annual dividend payment is $5.69, which gives the stock a 4.33% dividend yield at current prices. At this stock price, the company has a market cap of $180 billion. And as we look at the quarterly non-GAAP earnings per share over time, you can see that they never really have a dramatic decline. So this company is always reliably profitable. And as I mentioned earlier, they usually trade at a 2 to 3% dividend yield. But with this recent sell-off, that's now up to 4.33%. And the forward-looking PE ratio is much lower than usual. As we look at PepsiCo stock on a per share basis, you can see annual revenue per share has grown at a 10-year compound annual growth rate of 4%. The 3-year CAGR is around 5%. Although fiscal 2024 was a slowdown in terms of revenue growth, the margins at PepsiCo are fairly strong with 54% gross margins, 14% operating margins, and 10.43% net margins. This is not as good as the margins on Coca-Cola, but these margins are still very good for their industry. Net income per share has grown at a 10-year compound annual growth rate of 4.77%, and the 3-year kicker is 8.17%. And then one of the metrics I like to look at most when analyzing dividend stocks is free cash flow. And this one's where PepsiCo gets a little odd. Their free cash flow per share actually hasn't grown at all over the past decade, with a 0.19% 10-year compound annual growth rate, and the 3-year CAGR is 1.16%. And as you can see here, when we look at the annual free cash flow per share, PepsiCo stock was on a crazy growth run up until 2015. At that point, their free cash flow kind of stalled out, but in fiscal 2023, they were able to reach all-time highs once again. And if we want to look at some more details around that, we can go and look at their cash flow statement. And we can see that they did grow their cash from operations in that time from $10.5 billion to $12.5 billion. But they ate up basically all of that with increases in annual capital expenditures. So their free cash flow is basically the same. But in that time, their dividend payments have increased a lot. It's gone from $4 billion a year in annual dividends paid to $7.23 billion. Speaking of dividends, that's the reason why a lot of people invest in this company. This is a great dividend growth stock. I mean, just look at this chart. Annual dividend increases year after year after year, and they have never had a dividend cut. This is reliability at its finest. The 10-year compound annual growth rate of PepsiCo's dividend is 7.31%, and the 3-year CAGR is 7.35%. However, the most recent dividend increase is on the lower end at 4.98%. And I would actually expect slower dividend growth for at least the next year. And I'll explain why as we continue talking about the financials, but also when we get to those key reasons for sell-off and the recent earnings. So how safe is PepsiCo's dividend? Well, I like to look at the payout ratio based on both free cash flow and net income. A lot of websites only show their net income-based payout ratio, which in my opinion is not a full picture look at the company. So as an example, you can see the current net income payout ratio is 75%, which is very safe for a company like PepsiCo, where by design, they're paying out a large amount of their cash flows as dividends. They do that on purpose. This is a very mature business that generates a lot more cash than they're able to intelligently reinvest. So it would make sense that the free cash flow payout ratio would also be on the high end. However, depending on the year, that has gotten to the point where it looks to be borderline unsustainable. As an example, in fiscal 2022, they had a 110% payout ratio, but then they had a better free cash flow year in 2023, and that went down to 84%. But in fiscal 2024, free cash flow per share was down again, and they had a 100% payout ratio. So does that mean PepsiCo's at a risk of a dividend cut? Not necessarily. As I mentioned earlier, this business has very high operating cash flow, which is still over $5 billion more a year than the amount they pay in dividends. And this CapEx investment is variable depending on what they're planning at any year. The company's balance sheet is also in a strong position. They have $8.5 billion in cash and short-term investments, and they do have a lot of assets they've built up over the years with positive shareholder equity. But similar to a lot of these large consumer defensive companies, they do have a decent amount of debt as well, which you would definitely say is a negative. They currently have $39.9 billion in net debt, meaning they have more total debt than they do current cash on hand. But these consumer giants often get away with that because of how predictable and reliable their cash flow is seen as. So we looked at the financials, and if you're not convinced about the company's dividend safety, I asked the AI analyst over on dividenddata.com to write a report about the dividend safety, growth, and outlook for PepsiCo. And I added, is there a risk of dividend cut? And did give this great write-up about their payout ratio and about their free cash flow. And a lot of that overlaps with what I just said. But they also emphasized the reliability of PepsiCo's dividend payment and the fact that they just increased their dividend an additional 5%. The 53 consecutive years of annual dividend increases highlights their commitment to the dividend payment. And the company gave outlook that they're expecting to return $8.6 billion in cash to shareholders this year, $7.6 billion of which will be from dividends, and $1 billion from share repurchases, which I will talk about in a bit. So overall, the AI analyst came to a similar conclusion as me, that the risk of a dividend cut is currently low at PepsiCo. However, the high payout ratio should be monitored, and it could slow down their dividend growth going forward. PepsiCo actually returns capital to shareholders even more outside of their dividend payment with share repurchases. They choose to be overweight, though, in terms of dividends, but you can see that they've been slowly decreasing their shares outstanding year after year. This is around negative 0.3%. So overall, I would say that the financials of PepsiCo are strong, the business is strong, and there really aren't any major red flags. But now let's get to the interesting parts. Why PepsiCo stock is selling off over the past year, and then afterwards we'll look at future earnings estimates for the company, analyst price targets on the stock, and we'll do our own DCF valuation on PepsiCo. So in the company's latest earnings, they reported a 5% decline in revenue year over year and a 10% decline in GAAP earnings per share compared to the prior year. They attributed that to geopolitical and macroeconomic conditions, including higher supply chain costs and a subdued consumer backdrop. Now, there are other large consumer products companies that are facing similar kinds of problems. Just off the top of my head, I'm thinking of Hershey, but a lot of that is due to cocoa cost. And I'm going to be honest, I don't think I really buy into this whole idea that there is a bad consumer market right now. Consumer spending is still very high. And if you look at Coca-Cola's business, they're not really seeing as much of a decline as PepsiCo, and they're actually projecting earnings growth this fiscal year. International growth is strong with 5% organic revenue growth. But the North American business, which is the majority of their revenue, that seems like that's where the pressure is right now. On the earnings call, PepsiCo reduced their full year earnings outlook. They cited new tariffs, heightened macro and consumer uncertainty, and they actually blame a lot of this on the performance of Frito-Lay North America. So actually, this does tie in a little better with what I was saying earlier. If their beverage business is doing well, that would line up with Coca-Cola because Coca-Cola is a beverage business. They don't have any snack business. And I have been seeing snack-focused businesses like Hershey and Mondelez see a decline in 2025. And that is cost related to tariffs impacting their profitability. I imagine PepsiCo will be able to weather a lot of that storm, though. Overall, the main reasons for the PepsiCo sell-off can be attributed to that reduced earnings outlook. And really, since we had that all-time high in PepsiCo's stock price, we've had slower growth year after year and then expectations of an earnings decline. So it does make sense that the stock price would go down in that time. But if you think long-term, that could be a buying opportunity. As I mentioned, you get that 4.3% dividend yield. And if you were buying it in years past, that could have been between a 2.5% and 3% yield. Ultimately, it will all come down to what PepsiCo does in the future. They did give some outlook on their latest earnings call, saying that they expect low single-digit organic revenue growth for fiscal 2025. So when I hear low single-digit, I'm thinking that means 1 to 3%. And the company is very focused right now on reducing their supply chain cost. So here you can see the future earnings estimates for PepsiCo stock among Wall Street analysts. They are expecting earnings per share to decline by 3.1% in fiscal 2025. And they also have revenue growth expected at negative 0.2%. So that is below the guidance that PepsiCo just gave. It should be noted this is based on non-GAAP earnings per share. And that P ratio of 16.65 is actually historically pretty low for the company. In the years beyond 2025, analysts are projecting a return to growth. That's just under 6% in 2026, 6.21% in 2027, and just under 2% in 2028. So with those 2028 earnings, you would have a 14.5 P ratio based on today's prices. So let's do a DCF valuation on the stock. To do so, I'm going to be using the AI analyst over on dividenddata.com. You can type in any ticker symbol like PEP and then just DCF valuation. And it will give you this full estimate, and then you can scroll down and use this calculator that you can customize and enter in your own growth rates. And I'm going to mess around with it to give you a range of different kind of intrinsic value estimates. And there are two kind of basic ways you can do it. You can do it based on multiple, so that is implying a share price based on an expected free cash flow multiple the stock would be trading at. Then you could also do it based on a terminal growth rate, meaning you have an expectation that it will continue growing at this set rate in perpetuity. So let's first do it based on free cash flow multiple. And it filled in 21.1, which I think is probably fair. We have revenue expectations of 0.1% growth, and then 3% in 2026 and 3% in 2027, but then it has 0 in 2028 and 2029. Let's put that at 3 and 3. This would give the stock an implied share price of $126.43, which is actually 2% below the current share price. but that roughly assumes PepsiCo is trading at fair value. Now, if you thought the company may trade at a higher multiple, like 25, then the company would be 14.92% undervalued. So you can see how finicky this calculation is. On the stock analysis tool, I do have this section called price ratios where you can see the historical price ratios for a lot of different metrics on a stock. So as an example, price to free cash flow ratio. And you can see in recent years, this has been anywhere from 20 to even as high as 44. But overall, 21 was probably a pretty conservative estimate. And I really wouldn't want to go higher than 25 with this. So overall, this is a pretty conservative estimate. But remember, you do want to invest with a large margin of safety so you can protect yourself from the downside. So let's switch to perpetuity. So if we assume a terminal growth rate of 2.5%, that would give it an implied share price of $217, which is 67% upside. So if we lower that to, let's say, 1%, that gives an implied share price of $140, which is 8.19% upside. So based on this, PepsiCo does appear to be undervalued, but there are a lot more variables you could consider when you're doing a discounted cash flow analysis. As an example, a lot of this depends on your discount rate that you use. In this case, your weighted average cost of capital. I would consider that to be low, which actually kind of inflates the valuation of the stocks. So again, look at these kind of as educational estimates and be sure to do your own research before making any investing decisions. We can also take a look at price targets for PepsiCo stock. Currently, the mean price target among Wall Street analysts is $150. The highest is $170, and the lowest is $110. So overall, this does imply some upside, but if you're planning to buy PepsiCo stock at the current price, you might not be looking for something that's going to outperform the market. You're likely looking for high, reliable, growing dividend income, and PepsiCo is a great example of reliable dividend growth, and you can get the stock at its highest dividend yield ever. So if your goal is just to have reliable dividend income in your retirement portfolio, this is probably a great choice and one of the best opportunities to buy PepsiCo stock in decades. If you enjoyed this video, please leave a like, comment, and subscribe to the channel for more stock analysis content. And if you want to use the tool I showed throughout, all of this is available at dividenddata.com. You can also get live access to my personal dividend growth stock portfolio that I update every month on the channel. And right now is one of the best times to join. We have our summer sale, which will only be available for a limited time. You can get 50% off our annual membership and lock in that low price for life. There's a 30-day money-back guarantee, so no risk in trying it out. The link is in the description and pinned comment of the video. Thanks for watching, and I'll see you in the next one.